Hey guys, welcome to lesson number 4 of the StockAbility Startup. This lesson, the Recession-Proof Business, is probably my favorite. I know I say that all the time, but I mean it. What an amazing opportunity to be able to profit in all market conditions, up, down, sideways. You're wondering, Sam, what are you talking about? Let's go right over to the lesson and find out now. When most of us first think about trading and investing, the assumption is we make money when things go up. And that is correct, but that's just one way of doing things. In a world where we've been taught to buy and hold, most investors are fearful when the markets go down. They panic about the loss, but the professional trader has the tools to potentially profit when markets go either up or down and even sideways. In our last lesson, we talked about bullish, bearish, and the terms long and short. Let's just recap on that for just a second now. Let's say I buy to enter. This is called opening the trade, and the price goes up on this particular stock that I invested in. We would say that I was in a long position, long the market, also bullish. Let's say, however, I decided to sell to enter the trade, i.e. the open, and then the stock went down from this particular point. This would be to my benefit, because then I could buy to exit and close the trade. This would be called a short position or bearish on the market. So let's just look at this from another perspective. I could buy to enter to open the trade and sell to exit for a profit, a long position, or I could sell to enter, opening the trade, and as the stock goes down, intend to buy it back to exit the trade and close. This would be a short position. If you're anything like me when I first started, you're thinking, how can I profit when the market goes down? And it's a great question. So let's go behind the scenes a little bit of the short, because it's a very, very unique principle. What basically happens is, if we decide to do something here, let's say the stock opens up at $40 and the price of the share goes up, and we hit a price target of say $50, and we decided that, hey, we don't think the market's going to go any higher than $50. We can actually do something called a short trade. We can short at $50 to enter. Now, you're probably thinking, well, how can I get into something if I don't own it? Well, this is what's going to happen, guys. When the stock was at $50, I can borrow shares from my online broker. So if you have a trading account with an online broker, you can click the sell short button when the price is at the level where you want to enter and immediately in real time borrow shares from your online broker. So we are going to short the market for our entry at $50. Now, as the day progresses, the market goes back down to 40 and later on in the session drops dramatically right down to $20. And we've decided, hey, this is where we want to close the trade to exit. So what we're going to do is we're going to buy to cover the stock back at 20. And when we buy to cover, the shares are automatically returned to our online broker. So we shorted at 50, borrowing shares from our broker. The price fell down to $20. We decided to close the trade and we bought the shares back for our exit and returned the shares to the broker. So what exactly happened here? Well, let's look at the mechanics. Number one, a share was borrowed, then immediately sold to another trader when the prices were at 50. We were paid $50 in cash. We had the cash, but we no longer had the shares which we borrowed. We sold those to somebody else. The stock price then fell, and as the price is falling, we still have the cash, but remember, we still owe the broker the shares. When the price got down to $20, we decided to buy back the shares that we owed the broker, but only paid $20. Now remember, we sold them for $50. Therefore, if we bought them back for $20, our net profit is the difference between what we were paid and then what we had to use to buy them back, which is a net profit of $30 per share. Pretty cool, right? This is short selling. And this is why this lesson was called the Recession-Proof Business, because potentially we have a recession-proof environment now in which the educated and disciplined trader could make money on trades when they go up and also make money when the market goes down as well. As I said to you before, most buy and hold investors get very nervous when the market goes down. A trader doesn't mind that. In fact, there's a saying on Wall Street that the stock market tends to take the stairs up and the elevator down. Fear and greed are some of the primary motivators behind the market, and people get greedy when things are going up, but they get really fearful when things go down, and we can take advantage of that. A lot of the time, you will see markets sell off a whole lot quicker than when they actually go up. Now, what we need to do is adapt to the market conditions here. Okay, so let's just say that we were bullish. If we were bullish on the particular markets on here, and remember we were in an uptrend on this, if we were bearish, we'd be looking for situations where we're in a downward trend. Remember, the third stage that we can have here
is the neutral market environment. So if we have a market that's trending up, we want to focus more on long positions. If we have a market that's going down, we want to focus more on short positions, okay? Profiting on the downside. Now, if we've got a sideways or choppy neutral market on here, what do you think we're going to do? Play both sides of the market. During those moves to the upside, we focus on long trades, and then we take our profit, and then we focus on short trades. Long, short, and we ride out this sideways price action for as long as we can until the market decides to show us the next trending direction it wishes to take. So, if you ask a trader versus the investor, what do you prefer? A lot of traders I know will say, hey, I really do like a ranging market because I can play both the upside and the downside on here. Now, you also may be wondering, well, why are we allowed to short? Well, part of that, guys, is because this gives liquidity to the market. Okay, if you can borrow a stock from your broker and sell it to somebody else, that's providing a bid and an offer. It allows the market to function in its full capacity as well. So you should be grateful for short selling, and anybody can do it. But there are some things that we need to remember, some points that are key to this, and I want to go through this with you right now. There are rules around shorting which apply to stocks only and also need to be factored in. So the first thing you should understand is you can't short sell a stock on a limited liquidity or float if there's just literally a knot of inventory out there as well. The second thing is your broker who you have your trading or investing account with actually needs to be carrying that stock that you want to short in their inventory. You can't short an initial public offering, an IPO, for the first 30 days. So, if you look at historic launches like Facebook, the first 30 days that Facebook was a publicly traded company, you wouldn't have been allowed to short sell it, only buying. So just remember that, guys, and it's something to be really cautious of right now. Any IPO in its first 30 days, I tend to avoid it. I tend to let everything play out, let the big institutions, the big players, put their mark on the market. And after that 30-day window, as long as the inventory is there with the online broker, we have the ability to both go long and go short. There is no time limit on a short trade. I get asked this a lot by newer students. Hey, do I have a certain time that I've got to close the trade out? No, the broker is happy to loan you those shares for as long as you need, okay? Because remember this, you have borrowed from the broker in the first place. You've just got to cover it by giving the shares back at some point. So they're happy to let you leave that trade open. Just remember this though, those stop losses, that risk management we talked about is key in all of this as well. So there is no short time limit on a short trade that we have to worry about on here, but there is something you do need to remember. If you hold a short trade long enough, you may actually be responsible for paying the dividend out rather than receiving the dividend like you would if you're actually a holder of the stock. Couple of other things to remember here. Most large cap stocks are shortable, and your online broker can also provide a master shortlist, as we call it. So when you open an account for the first time, you can say to the broker, hey, which stocks can I short that you actually have? And you'll pretty much find all the household names out there are all good. And in my career, I've never had any problem getting a short trade on any of the major stocks that were all familiar ones. Futures and Forex are something that we actively participate and use as asset classes in StockAbility as well. They do not have shorting restrictions like stocks do. It's just as easy to go short on futures and Forex. And, if you've not yet heard of futures and Forex, that's perfectly okay. We are going to be covering them in a little bit more detail in further lessons as well. But just remember this, okay? Short selling is a powerful tool for you to embrace and use. Just remember, like anything else, in our previous lesson, we talked about the importance of risk control and risk to reward ratios. Short selling is just as dangerous as going long and buying if you don't use protective measures as well. So anytime we go to any market and we do any kind of trade, whether it's a long or short, risk management is always our first focus, limiting the loss in case we get the trade wrong. And the disciplined trader does have opportunity. Remember that, no matter the market condition, as long as their primary focus is protecting their capital.
Okay, so some of you are probably thinking, that was really cool, and others are thinking, wow, I'm confused. I was in the latter when I first learned about short selling. I was very, very kind of confused about it and wondering what it really meant. Go back and look at the video a few times. Just hit the play button again and just check it out until you get it. It will become more familiar, and it's going to be a powerful tool in your trading arsenal. Being able to make money when the market goes up, down, or sideways. So now you understand about that concept. The next lesson, lesson number 5, we're going to embrace leverage and the power of making your money work harder. I'll see you next time.